If you're a business owner worried about how the sale of your business will play a role in your retirement, you're not alone. Studies show that 250,000 businesses are going to be listed for sale by 2030. But of those 250,000 businesses, only 10% will sell for contract value or above. So I'm not going to give you some probability of success or a nice graph that looks good on paper. Today, I'm going to provide you 7 things that you need to do before you sell your business. If I haven't met you yet, my name is Kyle Glenn. I'm a certified financial planner and exit planning advisor, helping business owners who are 50 years old and older transition on to their next chapter in life while protecting what they've built. Now, if you're anything like me, you want to know what's going on in your business and ways to improve it. That is the goal of today's video. Now, here's the first thing not to do. Don't just sell your business, because if you just sell, you're going to be creating yourself a headache, and 2, you may be leaving money on the table. I believe that the first thing that you need to do before you sell is assess where you are today. Now, that may or may not mean a professional business valuation performed for your business, but it does mean that you need to frame this with 3 specific questions. The first, am I personally ready to step away from the business? What are you going to do once you sell? The second is, how much does the business need to sell for in order to get me to my dream retirement? And 3, is the business ready for that transition? If you haven't done this planning before you sell, you're most likely going to regret it. Studies show that 70% of business owners regret the sale of their business within the first 12 months, creating a boomerang effect where the business owner goes back into business because they have not done the planning needed to ensure that once they have released control of their business, that they will be satisfied and content in a different area in a new chapter of their life. From there, you now have a baseline on how to move forward. And the second thing that you need to do before you sell is identify specific things within your business that needs improved. Now, this could be your sales department, your marketing, your people, whatever that might be. Create a list of items that you would like to have fixed before you list your business. This one allows you to have a track record of saying, here are the things that we have improved in the business, and this is what we're selling. But it also may provide you some insight, because if you are the person responsible for each of those items that you need to improve, it's a red flag, because it may mean that you are, 1, too personally involved with the business at this stage of your life, or 2, your business may not be valuable because you may be the integral part of your business. It allows you to see what specifically in your business is going wrong and if you may be a key part of that. It also allows you to test the strength of your key leadership team. If you assign tasks to be improved upon by your key leaders, it allows you to see if those key leaders can do the job that you ask them to do. The third thing that I would do before you sell is strengthen your intangible capitals. What are your intangible capitals? Well, these are the things that a business buyer is going to be buying from you. And I like to classify it as 4 specific things. The first is your human capital. The second is your customers. The third is your structural capital. And the fourth is your social capital. Human capital is, who are the people in your business that help you operate the business? Who is your key leadership team? How long have they been tenured? How does your departments work? Do you have clear structures, or does everything run through you? The second is customer capital. This is, how is your customers made up? Do you have a lot of customers with low revenue, or do you have a small segment of customers with high revenue? Mainly just allows a buyer to see what they're buying from a customer list standpoint. Structures are pretty simple. What are your standard operating procedures and structures in place that if a buyer is going to be buying this business from you, would allow them to continue on with the same profitability and ease of running this business as what you have. And the fourth is your social. If you're a service-based business or in the trades, this is a big one for you because reputation matters. But how do you know if intangible capitals are weak? Let's take your customers, for example. According to a study by BMI Mergers and Acquisitions, it says that while there is no formal definition of customer concentration, instead, there is some industry consensus that if a single customer accounts for more than 10 to 15% of revenue, or if your 5 largest customers account for 25 to 35% or more of revenue, you may have a customer issue. Now, you may have already addressed this already. No business owner wants to rely heavily on one single customer, so you might have already diversified this out. But if you haven't, it's a huge risk to you if you're going to list business for sale. Why is that? BMI continues to say that when a few customers represent a significant percentage of revenue, buyers are concerned about the short-term and long-term revenue volatility. When you step away, it may give those customers the right to then go shop a new provider for the service that you are offering. A buyer wants to have a strong customer base because they want retention. Retention leads them to a more accurate figure in terms of profitability when they are doing their analysis on whether or not to buy your business. Now, I will be honest with you, these first 3 points are the most time intensive and they are the hardest. But what's the best way to eat an elephant? One bite at a time. My fourth recommendation here is to continue on until you have these first 3 done and repeat as necessary, because this is the most important area that you need to be improving upon before you sell. Once you have an assessment of how much you need the business to sell in order to have your dream retirement, and you know what you're going to do in retirement, and you've done the work in your business, you are now ready to go on to the next step. And that is building out an advisory team. Most likely, you may have these advisors in your arsenal already. Many business owners have a financial advisor, an accountant preparing their corporate and personal tax returns, and a business transaction attorney that has created your business operating agreement. However, many of these business advisors do not talk to one another because of the confidentiality agreements that are in place within our industry. As a business owner, you are not going to be able to make the decisions that are necessary when going to transition your business without having a collaborative process in place with those board of advisors. So you need to build one, because this will allow you to determine which direction you want to go, whether an internal sale or a third-party buyer, with the legal, accounting, and financial advice at the table with you, so that you can make an informed decision for you, your business, and your family. Personally, I think it's good to have that end in mind of what direction of sale you want to go, so that you know how to form the structure. And that's point 6. Structuring the deal with your board of advisors advice is going to be important for you to do well in advance and to have planning in place to see how this could all lay out. Whether that be a note where over a period of 3, 5, 7, 10 years, you're receiving payment from cash flow as well as interest. Typically, that's very doable with an internal transfer. Or do you want to have that as a lump sum right off the bat, a clean break from the business? There is both a personal aspect where you are now completely out of the business, as well as a financial aspect with tax implications of a lump sum. That is why that board of advisors is so important, so that when you're in this next step of structuring the deal, of how you want this to play out, you have that good advice. And then point 7, get ready to sell. That may mean hiring a mergers and acquisitions broker to be able to market your business, or to go to your attorney and be able to get this structure in place for an internal transfer. I think that if you follow these steps, you're going to have a much more successful transition from your business and be able to reduce that risk that you are perceiving about your retirement. Your business most likely is your retirement plan, so you want to have this in place to be able to provide the retirement that you and your family are desiring. So, just as a recap, know where you stand. What do you have and where do you need to go? Identify and fix what is broken in your business. Build real value and repeat this until you feel satisfied. Build a counsel around you so that they can then direct you in the type of sale that you need to take. And then get ready for that exit, whatever it may look like for you. If you found this content valuable, please leave a like and subscribe to the channel. I want to try to get this out to individuals like you. I really enjoy doing it. Thank you so much for watching. Have a great day.